I got my pen here. Okay, I now call this meeting in order at 3:03. Do we have any public input or board communications? I've not received any myself. None? Okay.
Nope.
You should have or will see a email from the finance director that she wasn't able to get the report out yet. She'll send that later on. Then has everyone had a chance to read the minutes of August 13th, 2020?
Yes.
Yes, I move acceptance of the minutes as presented.
Okay, do we have a second?
I'll second.
We have a motion and a second to approve the minutes of August 13th, 2020. Any discussion? Not, say all in favor, say aye.
Aye.
Approved. We have authorization of payments for retirement fund for retirement benefits. We have 3 of them today.
I move we accept all 3.
Second.
We have a motion and a second. Any discussion? All in favor, say aye.
Aye.
Aye. Approved. Thank you.
Discussion about Tracy Jackson's 46 years.
Yeah.
Yeah,
They
So
had a
Cindy
nice-
just mentioned 46
Truly
years for
amazing.
Tracy. Yeah.
They did a nice thing. What was it? Channel 8, maybe?
Yeah. Yeah. Amazing. You're gonna stay till you hit 48, right?
Oh, yeah.
Cindy's gonna beat it. STI investments. Let's see. Pat on the line.
Yes, I'm here again. I apologize for the video. I did a Windows 10 update and my camera somehow is disabled completely. So I'll call the help desk after this call. I
No
don't know if I
problem.
can share my screen. Would you like me to try to share my screen, or
Yeah, give me a second. I'll promote you so I can give you rights.
we could see if that might work?
You are a co-host. You can now share your screen.
Good.
Hey, Pat, I think you're muted.
Okay, how's that?
Great.
Okay, great. Sorry about that. So obviously, we've been in a very turmoil year. We've had a pandemic going on. Last meeting, we talked about there might be a resurgence in the fall. We're seeing that resurgence now, so there's a lot of uncertainty around that. We have uncertainty around the election right now, uncertainty around the next possible stimulus coming out. So there's been a lot of volatility in the markets, most of it to the upside after the election results, but we're still seeing a lot of volatility on a daily basis. So what's been driving the markets higher? Well, it's really a 3-pronged approach, and we mentioned this before. There's monetary policy, there's fiscal policy, and then there's social and medical response. The Fed has been stimulating the economy. The Fed's been buying back bonds to support the fixed income markets. Now, we finally heard some good news from Pfizer, where they have a vaccine. It's about 92% effective, which is really good news. That's much more effective than any flu shot that we get any year. So we'll see how that plays out. Hasn't been approved yet, but that's big news. We've been waiting for that. And hopefully some of these other companies come out with vaccines that are very similar in nature as well, and we get those out to the population. So we're probably looking at spring, early summer next year, where we really start to see a sizable amount of people to get vaccinated and hopefully slow this coronavirus. So the market's really been responding to that 3-prong approach. So far, it's a V-shaped recovery. We've talked about that. Will it turn into a W? We don't know. We hope it doesn't. We don't want to see that kind of volatility. And we're keeping a close eye on all that on your behalf. So I'll move ahead here. And what I'll do is I'll put this in a slideshow so you can probably see it a little bit better. So why don't we just talk generally about the markets and the indexes? There's two timeframes here we're looking at. So we're looking at on a 1-year basis and then a year-to-date basis. And you can see on a 1-year basis, US large caps have done very, very well. That's kind of been the strength in your portfolio, where other areas like small caps, developed international, really haven't participated in the rally. Emerging markets did relatively well on the equity side of the equation. Really the big winners are US investment grade bonds, long duration bonds. So where you wouldn't think it would come from, it did. It came from bonds. So we'll talk about yields and what happened and why we saw strong returns. But I think that's important because diversification did work. You have allocation to all these asset classes, and it definitely benefited your portfolio. The US equity market, this has been going on for a long time. Look at the lower left-hand side of this page. You can see value stocks have underperformed growth stocks significantly for about 5 years now and running. So the big story there, and I want to touch on that a little bit more because I think that's an important conversation. We'll touch on that in the next couple of slides. That we're seeing those big technology stocks really kind of lead the way. Those stay-at-home stocks for obvious reasons. A lot of the economy shut down. Stay-at-home stocks make sense. You know, if you can stay at home and participate, like Zoom calls and things of that nature, those companies have done very well. Peloton, anything you can stay at home, exercise equipment, things like that, have done very well in this type of environment. So let's focus on these big names. So we talked about FANG stocks in the past, Apple, Amazon, Facebook, Google. Well, let's throw Microsoft in there as well, because that's a lot of cloud computing. Obviously, you know, Microsoft's Office, things of that nature have done very well. You know, these companies have tremendous growth this year. So I wanted to look at this from two standpoints. Let's look at just generic indexes, the MSCI ACWI index, which is all developed international, includes the US. How did that stack up versus these top 5 stocks? And you can see the ACWI index was up about 17%, where these top 5 stocks were up north of 35%. So a tremendous differential there. So we looked at it on the US side of the equation as well, the Russell 3000, which includes all large, mid, and small companies, and how it looked. And it's a very similar pattern. So we're seeing just 5 names, which now represent over 25% of the S&P 500. Now, collectively, the market cap of these stocks is larger than all European companies. So it's very, very sizable. A little concerning, perhaps. Can we maintain this trajectory? Most likely not. Remember back to the credit crisis where, you know, we had these high-flying tech stocks do very well, and then they sold off very significantly. Could that happen again? Well, it might. If this pandemic drags out, these stocks could continue to do well. But if we do get a vaccine and we slow the virus, similar to what we've done with the flu in the past, then what we'll see is these stay-at-home stocks will sell off and sell off pretty significantly. So we want to make sure we're in both areas of the markets to take advantage of the companies that were left behind. Now, the good news is you're indexed right now on the equity side of the equation. So you've participated in this rally. And when it goes the other way, you're going to participate in those companies that are in the index which haven't done well, and these other companies might sell off. So you're kind of in a good position. Active management really struggled during this time because even if you had a 0.5% underweight, let's just say Facebook, you underperformed significantly, whatever your relative index was. Just another way to look at it on page 8. More commonly used indexes, we have a FANG index here. You could see the bright blue bar, how well that's done relative to the NASDAQ and the S&P 500. It's very significant what these stocks have done in the equity markets. Any questions around that? Okay, so international, the US has led the way for quite some time. We have seen some bright spots in the markets. Areas like Asia have done relatively well. Some emerging markets countries, Japan all in all has done well. You know, we're seeing some of these Asian countries do well because, you know, it's kind of like the accounting method, first in, first out, right? So China was the first in with this pandemic. You know, now their numbers look better than anywhere else in the world. It's growing in Europe, it's growing in the US, it's growing in South America, Central America. So, those countries are starting to do well. And the numbers from Asia or numbers from China came out with global or GDP growth around 4.5%. So that's better than anywhere else in the world you're going to get today. So those countries have done relatively well. I anticipate they'll continue to do well, but there's still some troubled areas in Europe. They never really got out of the recession from the credit crisis. And this pandemic just really kind of doubled down on that and really hurt a lot of their economic prospects. Fixed income, this is a pretty amazing story where we were. We talked about yield curve inversions. We were there back in 9/30/2019. You can see where we are today. The inversion's gone on the yield curve, but rates have come way down. And overall, the yield curve is steepened. So what's that mean? It means the short end is much lower in yield than the long end. And you can see how it's steepened out there. The good news is you're kind of right in the middle of that yield curve with your fixed income strategies. So you definitely participated in all this with the returns on an absolute and relative standpoint within fixed income. You could just use these for your minutes on page 11. I spoke through most of these bullet points. And we'll move ahead to slide 15. So here we are on a fiscal year-to-date basis. So we're talking a 3-month period here. You're up 5%, just over 5% on a net basis. And we're doing relatively well versus the index. We're beating the index on a fiscal year-to-date standpoint. The good news is, because our numbers have done so well recently, our longer-term numbers are picking up. So even on a net basis, we're closing the gap on the index, which is good, because you got to remember, all the fees that SEI charges is all inclusive of everything we do, not just investment manager fees. So it's good that we're closing that gap on a long-term basis. Where did your performance come from? We'll look at some of the funds down here. Obviously, large caps on a fiscal year-to-date basis had the best return, about 9.5%. You could see the S&P small cap strategy there, up about 3.2%, kind of followed the slides that I talked about earlier. So positive returns, but muted compared to large caps. International on a fiscal year-to-date basis, a little higher than small caps, 4.8%. And then emerging markets kind of hung in there with large caps on a fiscal year-to-date standpoint. So almost 9% for emerging markets. Again, all index strategies. Core fixed income up about 1.22% on a fiscal year-to-date standpoint. High yield bonds did pretty well, almost 6% on a fiscal year-to-date basis. And then the REIT fund had positive numbers as well, about 1.13% there. So all in all, the diversification helped. Some areas did a little better, some areas did a little worse, but all in all, a nice positive return on a 3-month number. Any questions around the returns?
Pat, do you have year-to-date through November or sometime in November?
Yeah, I will be pulling that up in a second. I'll keep the meeting going here because that's the end of my presentation, but I'll have that number for you in just a second.
All right, thanks.
Any other questions about the markets in general?
Hey, Pat, this just given what we've all, well, I guess we're all still going through it in terms of the election. Any forecasting or ideas of what a new administration means, if anything, at this point with respect to investments?
Well, I think first of all, with Congress most likely going to be split, we're going to be in a situation where there's kind of gridlock, and the markets really like that environment because right now the tech stocks, when it initially came out that Biden was called the winner, the tech stocks sold off pretty significantly because right now there's a lot of Regulation D things going on with tech stocks, and they're concerned that that might come to fruition. But But all in all, I mean, the really things that are driving the market right now are, there really has to be a new stimulus package. If we don't get something soon, all that money that went out to the people and organizations, the savings are starting to go away. And if they don't get another round, that's going to be a problem for everybody. But all in all, I think the markets are, we're going to have a gridlock. That's good for the markets as a whole. Usually a risk on atmosphere when that takes place. So, if we do get the vaccine sooner than later, that's going to be the biggest thing driving the markets. And I think what you'll see is those more defensive names, cyclical names that have been held back because of the pandemic, because of shutdowns, those names will be the big winners going forward. Those more value-oriented corporations.
Hey, Pat, this is Ken. I think you saw that, when the Pfizer vaccine was announced and you had that quick 1 or 2 day rotation where everything that had gotten beaten up, for the last 6-7 months, really came back strong. Those tech stocks, those NASDAQ type stocks really, came back to the pack. That was maybe relatively short-lived as the number of COVID cases is announced, and it's the thought is that maybe the solution isn't as quick as it may be, but I think you see what could happen, if in fact we get back to any sort of normalcy, however we define that.
That's exactly right. So, the markets have initially reacted to it. Obviously, this is a tremendous undertaking with their vaccine. It has to be at a very cold temperatures. It's going to take time to get out to the public. It's going to take a lot of logistics are going to have to be in place for this to happen. I think the markets absorbed that, and they absorbed the new numbers coming out with spiked coronavirus cases across the country. And we saw that revert a little bit. So I think you're right. I think that's kind of a look into the future, what could potentially happen if we do get this vaccine out to the majority of the public, what we could see happen going for a longer term basis, not just a couple of days. Any other questions? I do have the portfolio value as of yesterday. So the plan was up to $140,554,328.
Do you know what the return would be year to date?
I'll have to do a little quick math here. See where we were at the end.
I see you did this. You had 130.
Yeah, so you're up almost $10 million from September 30th.
When you said
Right.
$9.6 million you're up since the end of September 30th. Now, I don't know if there was any cash flows that accounted for that. There must have been some cash flows involved there because that's a significant number.
I think the contribution to the fund might have hit in October.
Cindy thinks a contribution to the fund may have hit in October.
Yeah, it had to, because if there was no contribution in play, that'd be a positive 7.4% return in
That's right.
October and November.
That's around 3 million or so.
Okay, so yeah, so we're up about another 3.5%, we'll say, so up north of 8% on a fiscal year-to-date basis through yesterday.
And to me, for COVID times, that seems pretty darn good.
Yep.
Yeah. Any other questions for Pat? If not, we'll move on to Sage View.
Hey, John, this is Ken. Can I share my screen?
Yep, well, give me 1 second here.
Okay. Okay,
And you should build share. Okay.
yeah, okay. You can see that sector composition?
No, don't see anything yet.
You don't see anything yet. Okay, let's share. There we go. Okay.
We have it.
Good. Okay. So I just wanted to follow up a little bit on Patrick's comments about the markets and you know, the differentials between large cap and small cap value and growth that, you know, significant going back a long period of time. This is a sector composition comparison of large cap, which would be the gray shaded bars, versus small cap, which is the green shaded bars. You can see obviously in technology, you know, really dominates on the large cap side. So more of the growthier oriented type sectors are really dominating the large cap, and on the small cap, you know, you've got financials with an overload, healthcare, real estate slight. So again, not surprising given where the markets have been, the differential between large and small cap. It is interesting in the fourth quarter, so far, month and a half into it, halfway into it, that the Russell 2000 small cap benchmark is up about 13% for the quarter. You know, that's about double, actually more than double that what you see on the large cap. Now, the question ultimately is, does that represent the rotation on a long-term basis, or is that, you know, kind of a hiccup in terms of where we are? And I think the operative word that Patrick used several times was uncertainty. And I think that, you know, absolutely will continue. So we're trying to gauge where, you know, obviously the markets will be going. I think the economy or the markets are projected that the economy will be recovering sometime into the second quarter of next year. But a lot of that will be very dependent on you know, whether the vaccine can be produced effectively, efficiently, and, you know, with enough dosage that we can get back to a normalized economy in a relatively quick period of time. So obviously more to follow. The challenge that we have in all of that uncertainty is trying to, you know, project where, you know, expected returns will be for the asset classes. We talked about doing some asset allocation studies and work, you know, for this quarter, and it's been difficult to really pinpoint where those expected returns will be, both on a short-term basis and then even on a longer-term 20-year type horizon. The work that we've kind of put together would suggest that that returns are pulling back, you know, particularly on the fixed income side. So not surprising that what we are looking at going forward on the core bond side will be lower than what we had been anticipating, projecting, you know, as short as a year or two ago. What that ultimately means in all likelihood is that the expected return of 7.25% likely will be, you know, retracing a bit, maybe closer to the 7% range. But we really want to get a better handle, better feel, hopefully towards, you know, the end of the year, first part of next year, in terms of what the expected returns can be for each of the asset classes that we'll be modeling going forward. So more to follow, you know, patience on that one. I appreciate that. But, you know, we're in somewhat crazy times. Tim's lived with you guys for over different periods of the last, you know, dozen years or so. And this certainly is one of them. So again, hopefully more to follow, you know, at the next meeting in terms of what we can anticipate for, project for expected returns, and the impact that could have on your current portfolio, and then the ability to say, you know, if we did some changes, increase equity, decrease equity, increase high yield, real estate, what impact that would be on the expected returns. Questions? Okay. Tim, anything to add?
Now you're gonna go through the fund compliance?
Yeah, I'm sorry. It's, yep.
Yeah.
We will do that. So good. Thank you. So as we, whoops, there we go. As we look at the funds themselves, again, that far right-hand column, the SageView ranking, is the metrics that we apply to each of the funds' performance characteristics to be able to match what we have in the investment policy statement and to be able to rank that relative to other funds of similar asset class status. And anything in green would represent a fund that either passes or scores within the top 50 percentile of a like universe. And as we can see here, each of the funds that are in the lineup do have a passing or certainly a top quartile, top decile type performance. So from a compliance standpoint, each of the funds meets the criteria established in the investment policy statement, so we're comfortable there. Questions? Okay. And interesting, Pat went over that, but again, some of the the recovery at the 3-month year to date, those numbers can look very, very different in this kind of year where that first quarter was so difficult, and then the second, third, and into the fourth quarter, certainly represent kind of a risk on, where the market's willing and wanting to take on a little bit of additional risk, and not surprising, as Patrick mentioned earlier as well, with rates being as low as they are. The question is, where do you go for any kind of return? So there's a willingness to take on a little bit more risk to generate that kind of return, given where rates are being so low. Any questions? John, that's all I have then. Oops. Okay. John, I think you're muted.
Sorry. Eileen is not here yet, so let's, Bob's gonna check on her. She's doing the presentation. I mean, she, yeah. There it is. Do we want to do the meeting schedule while we're waiting for Eileen? Does everybody have a copy of that? February 11th, May 13th, August 12th, and November 18th?
Yep.
Anybody see any issues with that schedule?
I'll move the proposed 2021 regular meeting schedule as presented.
I'll second.
Have a second? Okay, any discussion? All in favor, say aye.
Right?
Aye. Motion passes. Okay. We'll pause for a second. She should be here any minute. She had planned on 3:30. Oh, she's having a little computer issues. She'll be in a second, hopefully. Hello, Eileen. Eileen has joined us. Eileen, I'm going to make you a co-host so you can share your screen.
Okay, thanks.
Okay, you are set to share your screen.
All right. Hello, everybody.
Hi.
So I'm here to talk a bit about the cash balance plan. And first, let's see. Oops. Hopefully, can everybody see the document that's on the screen about the cash balance plan?
Yes.
Yes. Okay. So first, just as a little bit of background and history, The town council over a number of years ago had been considering how to approach potential modifications to its pension plan. Certainly looking for ways to save money, as a defined benefit plan is quite costly. After I'd say it was a process of a couple of years, the council decided that it would like to pursue a cash balance plan for both new union employees and new non-union employees. And we've been working with both Hooker and Holcomb, as well as, a law firm in Massachusetts, which actually puts together the specific plan language that would be needed to implement something like this. So that's sort of how we got to where we are. We've actually negotiated this concept or this plan into 2 union agreements. One is with the dispatchers and the other is with the supervisors. And it's on the table for another bargaining unit as well. But so the presentation that Bill shared, and which was in your agenda packet, I think is a really good summary of just what a cash balance plan is. So at the outset, again, there are 2 types of pension plans: defined benefit, which is what the town has now, with the exception of its 457 plan, and then defined contribution. The defined contribution involves putting a particular amount of money in, but then generally, it's up to the stock market to decide what you'll get out of it in the end. So more typically, a defined contribution plan might be something like a 401k, or in the municipal sector, the 457 or a 403b. Various communities were thinking about trying to go from a defined benefit to just a straight defined contribution plan. But that certainly puts a lot of risk, really puts all the risk really with regard to the, on the employee with regard to the pension benefit. So the council determined that it wanted to provide something that was sort of in the middle, and the concept of a cash balance plan has come up, and that's been discussed, I think, in a number of communities as well. So the cash balance plan, it actually is a defined benefit plan. So it ensures that employees will get a certain amount of money or a percentage of money when they leave employment. That looks like a defined contribution plan because both parties put in a particular amount of money. In this case, there are sort of theoretical employee accounts where a participant or employee's account is credited every year with what's called a pay credit, which is a percentage of salary. And it's generally a contribution from the employer side and the employee side, so 2 contributions, plus an interest credit, which depends on how the funds do over the year, what the type of amount of interest will be. So in this, in our case, the town council has indicated that interest credit shall be somewhere between 0 and 5%. This sort of protects the employees on the low end, so that if there's a bad market year, they won't lose any money. And it also says, though, even if it's a really good market year, if it's over 5% interest, then the town actually takes the excess and presumably can use it to fund future benefits. So the town, is noted, currently has a defined benefit plan, and the way that cash balance plans are similar to these are as follows. There's security, a benefit based on a formula. It's funded by a pool of assets, so you can invest for the long term. And in this instance, that pool of assets won't be separate from anything you have now with the defined benefit plan. The cash balance plan monies and the defined benefit monies go all together in one pot. The town manages the assets, retains the risk, investment risk. There's an actuarial calculation to determine the cash contribution each year. And I think this one is important. The cash balance can be converted to an annuity when a participant retires. So the individual can take a lump sum, but he or she can also have it converted into an annuity. The cash balance plans operate differently from defined contribution plans in a variety of ways as well. You do have your balance sort of expressed in terms of an account balance. The employer contributes a specific percent of pay to the employee's account. And again, this hopefully would allow the town to be able to plan more easily for what it would need to contribute. Interest credits are added to the account at least annually, again, at the sort of end/beginning of a fiscal year. Annual statements are provided of account balances. A lump sum typically is offered as a benefit option. And there is some, portability to this. It can be rolled over into another account or an IRA, etc. So in an example, just to help us understand how this works, if we take an employee who earns $30,000 a year in year one, there would, and we take an employer contribution of 5% plus an employee contribution of 5%. Then in the year one, the individual would have, as part of his or her account, $3,000, because that would be 10% of $30,000. That amount carries over into year two, and then any interest credit is added in. In this instance, in just the example, it said there was a 4% actuarial return. So 4% of $3,000 is $120. So that gets added in, as well as then at the end of year two, when now the employee's compensation has gone up to $31,000, it's added again now $3,100 for the 10% with the pay credits, and there's an ending balance of $6,220. And this just continues. So then year three starts off with $6,220. If there's any interest to be added in, it's added in. And then at the end of the year, you have the pay credits added in, meaning the employer contributions. So that's just sort of I think that the basic outline for the cash balance plan, and just in terms of an understanding of how it functions, how it works. I think from the employee's perspective, at least what we found in negotiations, is that this certainly it's more preferable perhaps to something like a 401k, because the employee does have certain certainty in it. However, on the employer side, the employer gets certain certainty as well, meaning that, you kind of have an idea of what your contribution is going to be each year. And so I'm just going to pull up another doc. So, in the course of deciding whether or not to make a move to a cash balance plan, the actuaries did put together a computation to compare what the cost to the town was of the current defined benefit plan as a percentage of payroll for non-union employees. And if you can see at the bottom of this of the first page here, it says cost as a percentage of pay. And it says 5.4%. That's the estimated cost of the defined benefit plan right now. And when this is compared, the defined benefit plan for non-union, when it's compared to the cash balance plan on the second page, the analysis, so when you think about it, is the employer's real liability is the 5% that they're going to contribute. And then the interest is what the interest is. If it's whatever 1, 2, 3, 4%, it's something that's added on. It's not something that the town had to necessarily plan for. If it's over the 5%, then the town would have additional money to fund as years go forward. If it's less than 0%, the town's going to be sure that the person doesn't lose anything. And I really don't think that the town is losing anything in that point with regard to the employees either. So in comparison, the actuaries determined that the cost of this cash balance plan for non-union employees was 5% or less as time would go on, because presumably if you had good market return years, you would have the additional money each year or from time to time. So I think these were some of the things that were important considerations for the council. it gets a little bit tricky when you go to implement any of this. Because while our actuaries have put together, I'll just pull up one other document. Our actuaries had put together a summary plan, which allowed us to speak with, our unions about what the nature of a cash balance plan is. This goes through with a little more definition about typical things about what's normal retirement, what's an early retirement, etc. This certainly isn't fleshed out in significant enough detail. So as we walk through it, and again, it is sort of a hybrid product, because you have not just the account balance available, but because it's a defined benefit plan, there are provisions for disability retirement, and other optional form benefits. So it has to be spelled out pretty carefully and consistent with the law. So the town's working with, as I think I mentioned, a firm from Massachusetts to have them put together, the full plan provision, both for non-union and for union employees. And on the union side, again, we have a couple of different documents that govern this. We have the non-union terms and conditions, we have non-union retirement plan, and then we have the ordinance. And because of just changes over time and the ability to make some changes over time to the retirement plan as provided in the non-union terms and conditions, and the retirement plan and the ordinance don't really match up right now in terms of what an employee's benefits are. So we're trying to kind of clean that up as well and bring it up to date, and have this formal document ready to go and to present to the non-union folks as well. So that's where we are in general, and I'll be happy to try to answer questions folks may have related to this.
And Eileen, if I remember correctly, one advantage is if we did a defined contribution, we'd have to invest to kind of track things separately. With this, it can be blended into the current funds. Is that correct?
Right. I think it's a definite benefit that, yes, this can be blended in with the current funds, and it's they're called theoretical accounts.
And it keeps your DB open rather than closing it,
Right.
So
Eileen, go ahead, Mark.
Eileen, this is Mark. A couple questions for you. So I understand, okay, so the funds can be blended or put in one account, but are they segregated at all? Is there a way of tracking over time how the sub accounts or sub funds are doing one way or the other, or no?
I'm venturing I don't want to say a guess, Mark, but I don't know the exact answer, but I assume that there is a way to keep track of that, because you have to be able to know, presumably, whether or not you're getting the benefit that we thought we were getting, right, going forward.
And I'm thinking back to the issues that we dealt with Pequannock Bridge and others.
Yes.
Way back when, well, really not that
Right.
long ago, but how is the percentage, the 0 to 5%, how is that determined every year? Is that specific action by the council, or is there an actuarial determination of how that is determined?
Yes. Well, there is. We did decide on a specific number, and I apologize that I'm blanking right now, but we decided that there wouldn't be it wouldn't be a mystery thing, or wouldn't be a guess thing. It would be, I forget if it was a CPI or what it was. But
so it's indexed to something.
Yes, it's indexed to something so that there's no question.
Okay. And lastly, and I think I know the answer, but is this an option for folks, or is this mandatory for new hires? Depending on whether or not the unions have agreed.
Right. So two of the unions have agreed that it would be mandatory for new hires. I mean, that date's going to be put out, still a bit while we're trying to get everything in order, meaning the
Sure.
documents, et cetera, in order. But yeah, they've agreed that new hires will go there. We've also talked about the possibility that if somebody has only been in the employment of the town for a short period of time, I think we're talking like 1 to maybe 5 years, that they might be able to transfer over to this if they wanted to. And the benefit to that in part for them is that it is more portable. So those were a couple of things that we were looking at. And, in addition, we have not started negotiations on the pension agreement for the police, but what you might hear coming back from that is it might be quite different, honestly. It might not be the implementation of this. That's kind of just a different animal.
And for non-union, it's just mandatory going forward since there is no
Right, it will be.
negotiation.
Right.
Yeah,
Thank
I
you.
have just one question, Eileen. This is Carol.
Sure.
So it's
Hi.
only for people who are new hires and for someone who has perhaps not been employed by the town less than 5 years. If someone was employed, say 10 years, they could not take advantage of this?
Right. We would not get into a transfer of that. Of course, we certainly spent some time talking about, yes, would we want to change our defined benefit plan and have people move over? But I think, the better thought of that was to say, no, let's really focus on new employees.
And Eileen and everyone, if for an employee that's been here those 1 to 5 years, wherever we decide, it's entirely their choice. It's not like it's going to be forced on them. It's only going to be forced on new hires.
I have a question. This is Jason. If you want to, can you pay more into the plan as an employee, more than the 5%?
I don't believe so. I think it's a cap, but John, do you know the answer to that question?
I didn't think so, but I'd have to double check.
Yeah.
Just because it would change the percentage, if someone wanted to save more towards retirement, they could use this plan to contribute additional into it, and then you get the percentage at the end of the year.
Right.
So the next thing is, as this plan takes
Right.
over the whole, everything, will this plan be able to fund the active pensions that are already in retirement as it turns over, you know what I mean?
Right. I think that's where it's helpful. I think that you're still going to have the funds will be mingled and you'll still get an actuarial determination going forward of what the town's cost is. So they won't be separated out. They'll be together. And yeah, it's certainly our hope that, as things go on, that would cover whatever the additional or the remaining costs were.
I'm thinking as time goes on, you have more people than a defined pension at the end. As they're retired, you have less money going in. The town might have a big egg to put in.
I'm sorry. I don't think they would have a big egg to put in because I think that's all considered, each time the actuaries put their numbers together.
Okay.
Eileen, hi, this is Tim Burns.
Hi. Hi.
We're the investment advisors for the committee. So is this committee, the retirement board, going to be responsible for this new plan?
Responsible for the new plan. I think to the extent that it's responsible for the existing defined benefit plan, yes.
Okay, so they'll have two plans now. And so I'm curious, I'm curious about the sort of the commingling of funds and the sort of asset allocation for the new plan. You're suggesting it will just follow the old plan, or will there be a determination made as to whether a better mix of sort of risk and non-risky assets is more suitable for the new liabilities? And it has something to do with this sort of the crediting rate. So I think on the presentation I saw the crediting rate will be based on actual portfolio results to the extent they're between 0 and 5%. Now that's different from what you suggested, which was there may be an index, some kind of an index amount, but.
Right. It's right. I'm pretty certain that we looked at that and had that concern as well, that you didn't want to have a concern or a difficulty about figuring out what that was.
Yeah, yeah. So I guess it's just, so the thing with the cash balance plan, the issues sometimes are if you're 18 years old and you're a new entrant in a cash balance plan, you might prefer to have a larger, sort of a larger return. You might be able to accept sort of a kind of the equity risk. If you're close to retirement, you may want sort of, a safer return. But anyhow, I'm just trying to figure out the asset allocation decision. The factors you might consider for the cash balance plan could be very different than the factors we consider for the DB. So, commingling the funds, and I'm just curious and kind of interested how we'll do that. But in any event, it's the committee's responsibility. So maybe we'll have a role in trying to help sort that out.
Tim, this is Cindy. I think that this is going to just be combined into one fund. So if it's one fund, I don't know how we would allocate the assets separately.
Yeah, well, if it's one fund, you probably wouldn't. I mean, you could have a master trust account and have two sub accounts that have different objectives. But I think, I don't know if anybody considered this, but if we're carrying a 60 or 70% kind of equity allocation in one account, I think the year-to-year results will have a tendency to be either well under 0 or well above 5. So there's going to be maybe a more substantial kind of over and under in this new plan, rather than being somewhere in the range of 0 to 5. If you want to be in the range of 0 to 5, my guess is you would select a less aggressive asset allocation for the new liability set. Does that make sense?
I don't think there's and I might not be clear on this either. I don't think there's an ideal or a goal to say we have to be between 0 and 5%.
Yeah. Okay.
It's sort of what happens in some respects.
Yeah.
If there's a good year and if it's 7%, for example, then that additional amount, stays with the town and it can be used to fund things going forward.
Okay. Okay. A lot of sponsors who adopt these, one of their primary objectives is to avoid kind of underfunding, I guess I'd put it. So sounds like the town is going, we'll take the over and under over time, and it is what it is.
I think a variety of the other plans that were actually discussed had a much higher end. It might have been up to 10% or up to 7.5% or something like that.
Yeah.
And this seemed just to be more, I think, prudent, conservative at the present time.
Yeah. Okay. All right. Well, thanks for that. Appreciate it.
Sure.
Any other questions? Yes. Okay. Thank you, Eileen.
So-
Appreciate it. Oh, Mark, you have a question?
Yeah, I'm sorry. Just because so everything's going into one account, and it sounds like there really are not going to be sub-accounts, so there really won't be a way to determine the savings or the benefit or not the benefits of this new program. That's kind of what it sounds like to me. If we don't create sub-accounts and be able to evaluate them, including whether or not there should be a different investment approach for one or the other, I think, which I believe is what Tim was raising early on in his comments, then there won't be a way of determining if there's really much benefit, or maybe there's great benefit to doing this.
Well, what I think, if I follow this correctly, just from the basics of the plan that Bill outlined, that the town's going to be contributing 5%. We know that the employee is going to be contributing 5% under this plan ideal. And then if hopefully, we're gonna have more than a 0% return, but anything, right? I know, all right, so maybe I'm being hopeful. Anything over that, I think it works out okay, so to speak, because if it winds up being over 5%, the return, then the money comes back or stays with the town. So I think you're still looking at it and saying that the cost of this benefit, I think what Bill was describing in April 2019 is that the cost of this benefit, it's pretty standard or more easily identifiable because it's going to be the 5% plus, whether it's part of this, it's the interest, which it's not necessarily, we're not paying it out, it's interest that we've gained. Does that make any sense? So, he's saying over time, I think however you looked at this, you would say, yeah, well, it's going to cost, 5% or less.
So in a nutshell, the town's annual contribution will be less.
Will that happen immediately? No. Will the town's contribution be less over time? That's certainly the anticipation with this. When you look at it, that the cost of putting in 5% at the beginning of time for an employee is higher than what you would be putting in now for an employee on the DB plan. So there's a point in time when those two things, intersect and cross, and then this plan winds up being less costly over time.
And if we would have did the defined contribute or the contribution, right? Yeah, defined contribution plan that closes the DB and your costs go way up right away. So this isn't as shocking as doing that. And then we were just talking here in the room that probably HR will track it, how much, our 5%, how much, interest came in each year, how that applies to each account. And we'll track it internally on, over time and how that's doing. Any other questions?
But the retirement board will still have to determine the asset allocations.
Well, as it is, it would just be depending if we do a sub. If it's one fund, it'll just fall under the existing. You won't do anything different. But it's probably something we want to talk about, whether it should be two. I saw subclass or some category.
Originally, we thought it was going to be two funds, and there would be
Right.
two actual reports, one for this one and one for that one. But then ultimately, we decided, or I think Hooker and Holcomb decided it could be one fund.
Right. Okay. Anything else for Eileen? Okay, thank you, Eileen. I
All
appreciate
right.
it. Have a good
Eileen,
night.
Thank you.
Okay, I don't think we have any other business on the agenda. So our next meeting's February 11th, so we'll be out of this year, which is great. Can't wait. Do we have a motion to adjourn?
I'll make a motion to adjourn.
Thank you, Jason. Do we have a second?
Second.
Thank you. All in favor, say aye.
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 Thank you. We are adjourned.
Merry
See you
Christmas.
later.
All right. Oh, yeah.
Yeah, take care,
Happy
everybody.
Christmas.
Stay safe.
Okay.
Happy holidays.
Care,
Take
everybody.
care.